Welcome to our New Year trade planning session. First of all, I want to wish you all a very happy Merry Christmas and a Happy New Year. And I hope 2012 will be a very prosperous and successful year for all of you. And I just want to share with you a simple idea, or no, a general idea of how we approach the market or how we trade the market. The approach we have is called price behavior. And price behavior is a unique approach to the market. We are the only ones that follow that process. We have trained a lot of people on following it. And what price behavior offers is gives you the ability to make sense of what's happening into the market and understanding the charts, and a simplicity in the approach. So it gives you sense and it gives you simplicity. What price behavior is basically, it is looking at the price and understanding that each price tick, each price move is the result of the belief of the buyer or the seller, that their conviction towards a market direction. So if there is a lot of buyers coming in and they believe that the market is going up, you would find that there is a lot of demand coming into the market, a lot of people are buying, and therefore they're pushing the price higher. And you can identify that by looking at something like this chart. And that means that now the market is moving upwards. Also, we as participants in the market, and by being able to analyze the market, we don't need to actually analyze the reasons behind why the market is going up. We will have a good understanding and a good knowledge and a good handle of the fundamentals of what's happening in the market, and we are aware of what's happening around us. But that price, that final tick that you would see at the chart, right hand side of the chart, is what we call the market wisdom. This is where the market believes is the value. This is where the market believes that the direction is going, and that is the wisdom. If we identify that market wisdom, which is the sum total of what everybody that is trading that market have decided that this is the moment, at this moment is the value. That last tick is the sum total of the wisdom of everybody that is trading in that market at this moment. And we as traders dare not argue with that wisdom. If the market says, and that is the value and that is my direction, then this is where we're buying, and that is the direction we are trading. And it's that simple. We identify the market condition, we know if people are buying or selling, and which way they are buying. The other thing also, which is very important about the market, is nothing trades in vacuum. Everything is trading in or about with each other. If now I am bullish on the euro, or I am negative on the euro, I will not go as a hedge fund manager, take all my assets that I have in the euro and dump it. I will try to start to begin to liquidate that euro, get out of my euro position, and at the same time I have to see where the money that I'm getting out of the euro, where am I going to put it? I'm not going to take the money and put it in the bank or put it under the mattress. I have to put it somewhere else. So the money that you see coming out from the euro like this, we will be looking at the market to see where this money is going in. And by looking at the market, that gives us a chart that's an opposite. So the chart will lead us from the market where money is going out to the chart where the money is going in. And we will be able also to identify where the strongest commodity or currency that's in the market, and this is the one we want to buy it. And we also want to identify the weakest, and that is the one we are going to sell. And if we're able to identify the strongest, and we're able to identify the weakest, when we're able to identify the best combination by taking the strongest of the strong, or the weak versus the weakest of the weak, or a combination. So if you look at this chart, this is the euro chart. I'm just giving you a quick example, and in this case you would see, if I go, for example, let's say right there, I'm going to give you an example of how the power of how we understand price behavior. I'm picking up. So if we look at this here, this is the euro, and you can see that it's going up, 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 and then suddenly it gets into an area where it begins to move in a sideways kind of a pattern, and on that way up you can see that people were buying at what they perceive as value area. They are adding to their accumulating more. Whenever the prices is coming down, they identify value and they add more, and they keep on adding more all the way up. They add more, they add more, they add more, and then suddenly in this area they add more and they buy more, but yet the prices doesn't go and take out the previous high. It comes back down. They add some more and they hope that it will continue higher. It goes higher, but instead of going all the way high, it fades. That is a sign of a major failure. And we, as traders, we have to identify and ask ourselves, who is the influencing party in this market? Where will the market go? Is this sufficient for me to tell me that the euro now is changing direction? Well, there is a way. If we understand behavior, and if we understand the behavior of the traders who are involved in the market, and if we assume, or we accept the fact that the market is the sum wisdom of the total wisdom of everybody that is trading in that market, then this move to the upside has been taken by the majority of the traders that are making a great deal of money. And therefore, we have to ask ourselves, if we were the ones that bought it at 128 and took it all the way up to 160, and we're up now 3,500 pips on our position, how will we protect our position? What will be the point where we say that this move to the upside has ceased to continue and now is the time for us to change direction? Well, these are the points of accumulation, and once the market accumulates and fails, and then accumulates a second time and a third time and fails, and accumulates a fourth time and fails, right there, this is the time when we say, okay, that is enough, and we are the ones who now we want to protect our winnings. Now we're going to get out. And the way we're going to get out is by selling in order to liquidate our position. And therefore, if we start selling, then we're going to bring a lot of supply or a lot of liquidity into the market, and that's what's going to happen. Now, having said that, okay, you would say, okay, this is easy. Okay, now you see this is coming down, and you say now this is liquidation, and now these guys, but now which way the direction of the market is going, up or down? Again, we fall back on behavior and the way the chart is structured and the way things are built. In this case, if I have an uptrend which is followed by what we call a price acceptance area and an ability to make any higher highs, and it fails, and then we get liquidation with momentum to the downside, that tells us that the trend has changed, and therefore what we need to do is actually at this point at 145, if I tell you make a trading decision whether to buy or sell, your answer would be, if it takes that momentum low of 144.47, that means that this liquidation is continued, because all these guys, if it breaks the 147, more guys are going to liquidate, more guys are going to protect their profits, there will be more selling coming into the market, and we will witness further liquidation. And that will be our trigger and our understanding. By understanding how the price is put together and what it means, then we have now the confidence in saying we are going to go short below 144.47, because we have read the chart correctly. We have taken the price, put it upon the structure, identified the market position, identified where the market has changed, and then we identified our entry. And therefore, right below here, this is where we are going to go short. And if you can see right now, there is your trade. You took it from 144 to 138. The same thing repeats itself. Now at 138, there is more liquidation coming into the market. Now it goes down to the 138. If it gets back again, this means that this liquidation is going to resume. Then I'm going to take it one more time, and you can see that right there. It breaks it again. We take it short. That is the condition. That's the market. That's the behavior, and you can stay with it. And there is your move, and you don't miss any opportunity, because you're not putting any bias. You're not setting any opinion. All what you're doing, you identify the condition, knowing where the traders are behaving and what is the how and why they are doing what they're doing, where they're buying, where they're selling, and therefore you can set yourself right on the right side of the market. Also, there is correlations, and if you can see here, for example, and what do I mean by correlation? If I'm going to go short the euro, let's say around the 5th of August 2008, I can mean that the euro now, if I have my assets in euro, then I might go and start shorting the euro yen. That's another opportunity. And if I go to August the 8th, August 2008, you can see that this one actually started on the 8th, but look at this decline. There was much bigger selling coming in to the market. There is a much more negativity in the market, and therefore our bias is to the downside, and there is a great opportunity now in taking, again, we can see that you could have taken the euro dollar short and then the euro yen. Now let's try another one. Let's take the euro Aussie, and if we go back to, and I moved the chart a little bit because I didn't want you to see what I'm talking about, so right there, going back to 2008, August to July, August 2008, you can see that the euro is strengthening, and actually it's beginning to push extremely higher. This was in August August 2008, when the euro dollar broke to the downside, when the euro yen broke to the downside. At the same time, the euro Aussie broke to the upside. Is there a trade that we can find here? This means that the Aussie is weaker than the weak currency, which is the euro. So this means we can sell the Aussie versus the strongest currency, which was the US dollar at the time, or we can sell it versus the yen. So this means just by doing your homework, understanding one single pair, it can give you multiple opportunities that you can take. So you can go, let's take a look at the Aussie dollar. And there is your it actually came before it, but worst case you want to take it on August the 6th. Look at the move. You had about 5,000 pips on that. Also, if you look at the Aussie yen, again we're looking at August the 8th. Look at this. So just by analyzing one pair, understanding which one is strong and which one is weak, and understanding the correlation and the inner relationship between one pair and the other, you can begin to search the market for opportunities that will confirm your bias. Because if I'm going out of the euro, I'm going to go out of all the euros. And in this case, we also identified a weaker currency that's weaker than the euro. And if I identify a bear market starting in the euro, and then I find that there is at the same time a bull market going in the euro Aussie, then wow, I can have a double bull market in the Aussie dollar, and I can have a double bull market in the Aussie yen. And that is the key of how to become successful in the market, and that's the key of understanding the price and price behavior and in the market correlation. Okay, so let me save that, and we're going to go and do the